Right, good morning, everybody, and welcome to Series 3, Episode 5 of Crystal's Complex Cases.
Live.
Live. You haven't tuned in to Loose Women. Just the three of us are trying to mix it up and doing something different, so hopefully it goes down well and we enjoy today. So those of you that are returning, thank you very much. And for those of you that are joining this webinar series for the first time, welcome. I'm Dan Morris, Key Account Director at Crystal Specialist Finance. We've got John McCaffrey, the tax wizard from Alexandria & Co, who doesn't need any introduction. And then we've got me old man, Roger Morris from Tandem Bank. Welcome, gentlemen.
Welcome. Morning, guys. And hopefully they're going to enjoy this where we're actually in a studio together. We just think it might be a different experience. And we've got plenty of questions already in advance, Dan.
Absolutely, absolutely. And we are live from sunny Manchester for a change.
Sunny Manchester.
So in today's episode, there is going to be a focus around bridging finance and how it can help you with your principal private residence tax issues. And then, as always, for the format, any questions that you guys have, anything that you want to hear, anything that you want to ask me, John, Roger, then please do. We try to make these webinars as interactive as possible, and they wouldn't be possible without the live interaction. So let's get straight into it, gents. Okay. Before we go into the questions that we've been asked currently, what are your thoughts on the end of the year and what that's shaping up to look like? Obviously, we've had a bit of good news. I think everyone would agree over the past couple of weeks in terms of base rate hasn't increased. Woohoo! And also going green has been essentially put on hold, so EPC having to be C in the next couple of years. So that's a sign of green shoots for the buy-to-let space. But where do you envision the year's going to end in terms of the market settling, because it seems to be calming, and I suppose the beginning of 24?
Yeah, my gut feeling when it comes to base rate, I think we'll stick at 525 longer than if we'd had another rise. It is baked into sort of 5 years Sonia that we were expected to go to 5.5, and I think everyone feels that would have capped out. But my gut feeling ahead of November's announcement is that base rate will stick at 525, but for longer. So it really does solidify before we then start to see it drop to what my gut feeling is the new norm will be about 4%, possibly 375, but I can't see it going below that. The reason at the moment you're seeing so many rate reductions has got nothing to do with lenders' belief that rates are going to drop. It's literally they're having very little volume coming in now. It's virtually all product transfers. I think the number one topic for you guys talking about both residential and buy-to-let, but specifically residential, is affordability. So we were discussing this morning that the next event that we're going to do in December will be a big focus on residential affordability. And John will give us the in-depth and basic understanding of how to extract the right income from a set of accounts that I think will help give you the edge next year. And when it comes to that specialist residential lending, Dan, Crystal have been outstanding. No other packagers supported Tandem Bank this year with the amount of inquiries and applications as Crystal has, which really shows it's an area you've really excelled in this year. So I think 2024 will all be about affordability and customer contact.
Thank you very much for that. John, what are your thoughts in terms of, well, the market?
The market, I'd say I'm busier than ever, and a lot of people are now talking about incorporations. A lot more people are talking about incorporations, which I think comes down to the affordability issue. Tax is a cost, and with the increase in interest rate, people holding buy-to-let properties with high interest costs are not seeing the relief, and in some cases are losing money despite still having to pay tax. So there's a lot more talk of people getting the structures right and putting properties into companies, even with the tax costs that can give rise to.
Perfect, thank you. And yeah, just my thoughts ultimately. So I think the market is picking up. We're seeing more and more transactions. I think we're seeing, again, some more green shoots on the back of the good news and the stabilization of the rates. And what we're also seeing and will see is the specialist market growing. it's inevitable that the specialist market is going to grow. This year, the current mortgage lending is about 250 billion, and 20% of that is specialists. Next year, it's anticipated to increase to 30% market share. So it's a huge market. And I'm not just talking just off high streets, residential and buy-to-let, but your commercial, your bridging and your development. So again, if it's not something that you're involved in, it's maybe time to look to get involved in it. But yeah, I do think it's going to pick up. I really do. Obviously, Rog mentioned around PTs. Every single broker out there screamed for PTs to be available for clients. The lenders listened, made it available, but ultimately that's had a massive impact on your income. I know most people that we're speaking to, they're 40% down this year just because a lot of clients are choosing to do PTs. So where do you get the money for your holiday from? Where do you get the additional income that you need for paying for your children's first car or 18th birthday party, or even just paying your bills? It's a specialist finance market. And hopefully during this next hour, we can answer any questions that you've got in relation to the specialist market, getting into it, and hopefully giving you a bit of confidence around dealing with these sorts of clients, which you've potentially never dealt with before. So without further ado, let's get into the questions and I suppose the hot topic for today, which predominantly you all joined for. So John, this is going to be an interesting one and probably heavily focused on our show pony.
Yeah.
So we are going to discuss principal private residence tax.
Yes.
What is that?
Right. So I'm seeing a lot more queries and a lot more questions around people and their main residence, right? And there's a bit of an idea out there that's like, you have a main residence, you sell your main residence, and that's it, there's no tax on it. But there's a lot more to it, and there's a lot more people who are looking to release value from their main residence, right? There's a lot of people who have large main residence who has a bit extra land to develop, and there are people who marry, and that has an effect on main residence, yeah? And there's a lot of tax issues, and as a broker, it's more than just funding up the house. A lot of it is just funding up the house. But from there's a lot more funding that can be done by the whole extraction of value from main residence. So, in tax terms, your principal private residence is the home you live in. Okay? And the basic rule is that the home you live in, if it is your only property, you pay basic rate of stamp duty. Okay, and the disposal of that home is free from capital gains tax. Yeah, so that's what it is, very basically put.
Yeah.
Okay, and it's brokers day in day out will be looking to provide lending to people who want to get on the ladder.
Yeah,
and fund up their main residence.
Okay,
yeah,
absolutely. Perfect, thank you. And leading on from that, how much land does that cover? Right,
so the capital gain on a main residence is basically if that home is used as your main residence, as I said, it's free from tax. Now there's two rules around the land. One, there's a rule in the legislation that says half a hectare, which is approximately 1.2 acres, can be covered by the main residence relief. But there's a second rule based in case law, which basically says anything to do with the enjoyment of the property and outbuildings relating to the enjoyment of the property can be covered by the main residence relief.
Okay.
So 1.2 acres is quite a sizable piece of land, right? I've got a number of clients who are subdividing their land, right? Selling off a chunk of their land or developing another property on their land, right? And making a capital gains free disposal on the disposal of that land.
Okay.
Because it falls within the main residence relief.
Okay.
I think that's worth maybe just going into that a little bit more.
Sure.
Because you made that quite sound simple, but not everyone necessarily have followed of why your relief's being made, and if you bought it in a different way, why you would have paid tax.
So, well, just before that, so just my understanding, if I bought a residential property that had a large garden, for argument's sake, I could in theory build another property in that garden, split it and then sell it and not pay capital gains?
Not quite.
Okay.
Right. What you could do is you could split it, sell the land.
Yeah.
And you wouldn't pay capital gains on the land.
Just on the land itself.
Right.
Yeah.
If you build property and sell the property, yeah, you will pay tax on the property, but not on the capital gain on the land.
Right.
Right?
Okay.
So to the point you're splitting off and selling off your land that you wouldn't pay the capital gains tax element.
Right.
Yeah.
Okay. Perfect. Yeah. And going back to your original question.
It was just making sure that everybody listening in could understand that. So if you're working with developers, specifically, a lot of the times, developers in that smaller stage, John, if I'm right, will purchase a residential and do major transformeric works to that property and sell it on because they won't pay capital gains because it was their primary residence. Is that right, John?
Yeah, if you can buy a property, if you live in it as your main residence, right? And then you do it up and sell it on, provided it was your main residence, there is no tax on that disposal. They need to be a little bit careful with that. If you're regularly buying properties, moving into them, doing them up, selling them on, potentially you might be running a trade, right?
Yeah.
And if you're running a trade,
yeah,
then it's going to be subject to income tax and there's no relief from capital gains.
Yeah.
But if you buy a property, you've got a couple of years in that property, you do it up, you make a capital gain, and you sell it on, there's no tax on that disposal.
So we got a couple of questions coming in. The first one is a really good friend of mine and Dan's, Robert Stopper. Rob, are you coming from Canary Wharf today? Is where my gut feeling is. And if you are, good morning from the three of us. So Rob's question is there a time limit on how long you can hold the split land before you sell and attract a CGT liability?
Well, what you do is you wouldn't split it until you've got a sale. Yeah.
Right. Yeah.
So it's your land, it's part of your main residence.
Yeah.
And you would only structure the sale at the point you are going to split it.
And just as a point, Rob, I often get asked when we have either we're looking at the property details or we do a valuation, and I'm sure Dan will come in on this as well, is the lender will look and think, particularly on residential or even on buy-to-let, where the value was indicated that there's development opportunities, either huge back garden, maybe there was outline planning given, and it's about trying to understand how that potential development of the land would actually affect that lender's own security is a real concern. And I know you get that a lot where you do bridging and
no, absolutely. You know, it's our bread and butter, and it's a good point which leads us well into the next question actually, and it's a really, really good question. So John, we bought the house. Yep. We've got a big garden. Yep. We've got planning granted. Yep. Does the increased value affect anything in terms from a tax point of view? No, provided that house and garden is used for your enjoyment at that time. Whilst planning is granted, right? Even if planning is granted to build the second property, it is still part of your main residence. Okay. Now, don't get me wrong. If you've got a house, I can come across this a lot, and people try to push it. If you've got a house like small holding, it's got 6 acres. Yep. Right? That outlying land is not part of your main residence. Okay. So if you develop that, you're not going to get the main residence relief from that. And is that as the crow flies? It's not. It's the problem with this whole area is, other than the ½ hectare that is in the tax legislation, it's all based on case law and interpretation. It's not. There's no set rules. Okay. Right. So it is. The case law rule is, if the land is used for your enjoyment, right? Now that's not, I've got some horses and I want to put them out, right? I need several acres. That's not for the enjoyment of the property, that's for your personal enjoyment. It is for your enjoyment of the property. Yes. So if you've got a house with a big garden, and that big garden is for the enjoyment of the property, it's those circumstances whereby people might think, right, you know what, I can subdivide that, sell it on, and I can make some tax-free money on this disposal. Okay.
So Rob's come back just to ask a further question. Hopefully that did answer your question, Mr. Anonymous or Mrs. Anonymous. But Rob Stopper's just following on from his original question has said, thanks, John, understood. That's the best route, but looking retrospectively, is there a time limit? So for instance, Rob, I'm just saying we bought a Victorian house with a big garden. I bought it 20 years ago, and suddenly I've realized that there's been a big change. I can get planning for the back garden. I maybe bought the house, certainly where you live, say 200 grand. It's now worth say 2 million, that bit of land could be worth a sizable amount. So as long as I haven't split it, I've had the land. Yeah, so there's no time limit within that. Hopefully that answers your question there, Rob. Thanks, John.
Perfect, thank you. Another one that's just in, John, we're having the questions thick and fast this morning, so thank you very much. I have a buy-to-let, so no main residence.
Yep.
Buy-to-let and live in it for 6 months before sale. Is the gain taxable?
Right, I get this question an awful lot.
Okay.
Right, okay. So the main residence rules are, right, what constitutes a main residence, all right? And people think it's fairly obvious, but it's not. That again is a case law based thing, okay? A main residence is the place where you live and can demonstrate that it is your home, right? And when the revenue look at that, they are looking at things like, where are your bills sent to? Where are you registered on the electoral register? Where's your doctor? Where's your dentist? Is it furnished, right? Is it furnished sufficiently? Is your post sent there? Okay. Is it occupied as your main residence? Okay. If the property has been your main residence for your whole period of ownership, the disposal is free of capital gains tax. Okay. There are a lot of people out there who believe, and it's a myth, that if I live in it for the last 6 months, the disposal is completely free. It's not. What the revenue do is they look at the whole period of ownership. They work out the capital, or you work out the capital gain, and they apportion it on a straight line time basis. Right?
So it's based on the percentage time that you've lived in that property versus ownership.
Correct.
Okay.
So if your chap there's had his buy-to-let for 5 years, and he lives in it for the last 6 months, right? 6 months, half a year out of 5 years, 10% of the gain will be free from tax, and the other 90% will be taxable.
Okay, fine. So that could cause quite a few implications, because what we've seen over the past couple of years at Crystal is first-time buyers, first-time landlords, which we'll come on to in a second anyway, because that's quite a hot topic, which mum and dad gave them a bit of cash to buy a buy-to-let whilst they're at university, left university, moved back in with mum and dad, decided they want to buy their own property to live in.
Yeah.
Obviously, properties at the moment, 100,000 are coming off fixed rates every single month, and they're just not yielding enough to ultimately continue with a rental. I mean, I've got a rental myself at the moment, and we've just remortgaged, and it's quite sickening, and we're only making £100 per month income. And if I need a new boiler or a couple of tiles on the roof, that's the profit gone for the year. So it's kind of pointless on certain assets, and that's why customers are diversifying. But we'll come on to that later again. So they're looking to offload that buy-to-let to get the deposit back out, to then release it into a new residential property. So regardless whether they moved into that or not, they're still going to have to pay the CGT on it, aren't they?
They are, but you've also got another issue there with stamp duty, right? So the guys will probably be aware of the first-time buyers relief, right? That relief only applies if you are genuinely a first-time buyer, right? If you have previously owned a buy-to-let.
Is that regardless of timescales again?
Regardless of timescales again, if you have previously owned a buy-to-let, your first main residence, you are not a first-time buyer. You are a second-time or third-time buyer, right? And that stamp duty relief that first-time buyers are entitled to isn't there.
Okay.
Right? So if you are considering a buy-to-let, and we've talked about this in other webinars, it may be worthwhile holding that buy-to-let in a company if it's your first, if you do intend to buy a more expensive or your own main residence after you bought buy-to-let. Holding it in the company owns it, not you. You are still a first-time buyer on your main residence.
So let me just come back into that, guys. Anyone who's heard me and John do this before in the buy-to-let masterclasses that I used to run previously, we often used to say, imagine you had a customer coming into you now, and as the example Dan said, you have got a son or a daughter of maybe your best customer. They've got buy-to-lets. They want to live at home, and their first property is going to be a buy-to-let. your automatic instinct is find the cheapest deal. So you go on the sourcing systems, who'll do first-time buyer, first-time landlord. Often, maybe at the moment on rates, NatWest would come up, other lenders are available, but NatWest, very clear. Not very clear in their offering of first-time buyer, first-time landlord, and you've picked the cheapest rate. First of all, the rate is irrelevant. It's the net income after tax is what you want to focus on, which means and can be irrelevant to actually the rate itself. Separate question on John for that one, but it's actually the tax position and that tax structure to where it goes for profit. So you purchase it for that customer in personal ownership with NatWest. But if you haven't given a comparison in a limited company, you've given tax advice, in my opinion. And then secondly, when the customer comes back in 12 months' time to get engaged, and they've told you they want to keep that buy-to-let right at the beginning, their first residential property is in effect their second home. And not only do they not qualify for first-time buyer allowance, they have to pay in England 3% extra stamp duty, and in Wales and Scotland, it's 4% extra. And the Ombudsman, in the cases I've seen, has ruled immediately against the advisor that they're responsible for the extra stamp duty because of the tax advice the advisor gave by not doing it in a limited company. So really, John, when you're dealing with first-time buyer, first-time landlord, the person who advises that structure of ownership should be a tax advisor.
Correct. Yes, absolutely.
If you are currently not owning, sorry, not that's not even proper English. If you currently don't own a residential property, you are 100% going to in the future.
Yep.
Is there any benefits currently to actually purchase an intended buy-to-let in your personal name, in your opinion?
If you work through the maths, if it's the only way you can afford it and you are in future willing and aware of giving up those reliefs, maybe. There is a cost to running a company. You can get an account to run a set of accounts for £500, £600, £700 a year, right? And I appreciate there's not a lot on margin on certain buy-to-lets at the moment, so you've got to get your figures right. But I would say in the vast majority of cases, that company makes sense.
Yeah.
We've got a question. There's two questions come in. I'm going to go the most recent one first. Morning, Paul. This is Paul Deans asked this question. So again, we'll give it to John. First-time buyer.
Yep.
Are you still a first-time buyer when you hold a property in limited company? Let me just extrapolate on that. This often gets asked, guys, that there is an urban belief that if you're 100% shareholder of a company, therefore you own that property in personal names, and therefore it kind of, that limited company is a bit of a myth. Now that's wrong, isn't it, John?
That is wrong. So in law, a company is a separate person, right? And it is the company that owns the property, not you. You are the shareholder and owner of the company, but you're not the direct owner of the property. And it may seem a technicality, but it's an important one. You are still a first-time buyer buying a property in your own name. It's the company that's bought the property.
And just before Dan asks the next question, let me give you something else to think about. If you are a landlord and that you've got, say, 6 or 7 buy-to-lets, and that's your primary income, you have no income from elsewhere, but after your allowable deductions, so for instance, your letting agency fees and your standard repairs, your net gross income is below 50,000, you may still be okay in that personal ownership. However, if you are have buy-to-lets in the Midlands or London, you may have recently seen exponential growth in what you can rent those properties for. So for example, take a property I have in Birmingham. 2.5 years ago, I got 650 a month for that 140 grand property. I'm now getting 975. Now that sounds really good, great profit. But what that's now doing is pushing people into a higher tax bracket exceptionally at the moment. So there is another negative consequence to privately owned buy-to-lets that are exceeding huge returns when it comes to rental income, because it's changing the effects of that profitability, and that can be easily misunderstood, Dan.
No, absolutely, because obviously individual names you're taxed on the income
You are, as it arises.
and limited company you're taxed on the profit.
So the company is taxed,
That's it.
not you.
Yeah.
Yeah, you're only taxed if you take
Makes it
out a
work,
dividend or
Yes.
a salary.
Yeah, because you can take X amount of dividends tax free, can't you?
Yeah.
£2,000 now.
No, it's
It used to be 5 though, didn't it?
yeah, but I think it is. I think it's 2 still. But then, man, it's always changing now. It's getting less and less. We will change.
Absolutely right. Next question. So, John, we have a client. This is an anonymous attendee. We have a client who lives in properties whilst he redevelops them and then
Yeah.
flips and moves on.
Okay.
I guess this is not the most effective way of doing things.
Again, it's something you need to be a bit careful of. So it's all about intention when you come to situations like that. If your chap is moving into properties, living in them, but basically is living in them to sell them on, he is to all intents and purposes trading. I imagine in his tax return, if he's even doing a tax return, is that that client is basically saying, right, I've bought a property, it's my main residence, I've done it up, I've sold it, I've moved to my next main residence, I've sold it, and each time is stating I don't owe any tax because there's no capital gains tax on main residence relief. The revenue do have an argument that they could come to him and go, actually, what you're doing is trading. You don't have a residence, what you're doing is living in an area while you're fixing it up, selling it on. And he or she could be subject to income tax on that. So yes, want to be careful. Now, to be honest, the safer bet is for the person to buy it in a limited company, pay corporation tax, reinvest the profits as he goes along and extract what he needs as a living, because the profits in company are generally low.
Okay.
Hope that answers that quick. By the way, can I just say, of all that we've been doing this webinar for a lot of years, these are the best set of questions we've had, and it's really good engagement. The next question we got from Stephen Birkin is one that's really close to my own heart, that's often misunderstood. So, Stephen, I do have a question which will help John give you a really good answer on this. So the question is, my partner and future wife.
Yep.
Congratulations.
Congratulations. Does that mean you're engaged? So you are living together. We'll see the importance of this. Has buy-to-let properties in her personal name.
Yep.
Stephen owns their main residence in his name only.
Yep.
He wants to add his future wife to the title for IHT purposes. What are the implications re stamp duty and possible capital gains? Now, before John speaks, my question to you, Stephen, is your residential property unencumbered at the moment? Because that's a factor, isn't it, John? And therefore, what amount of mortgage you have on that? Because if I'm right, John, let's say if the current mortgage you've got, Stephen, is 250,000 and you're adding the wife to the property, subject to the current lender being happy with that, you calculate on 50% of the outstanding mortgage when it comes to stamp duty. Is that right?
Yes, yes, it is right. So,
oh, by the way, no, I have an equity release mortgage. Can we ask?
To be honest, even equity release mortgages,
it's the
you need
same.
to be a little bit careful.
Right.
Okay. So my first thing I would say is wait till you're married, right? If you transfer it to her while she's just your fiance, in law, you are not deemed to be married, and there's a specific relief for spouses and civil partners, and you're allowed to transfer assets free of capital gains tax between each other. Okay, if you transfer it while she is just your partner, there is a deemed market value disposal, because it's not what's called a bargain at arm's length. You wouldn't give it away for free to anybody else, right? So you would have, now it's your main residence, so you wouldn't have capital gains tax on that, right? But I would suggest you do wait till you're married, because it's much easier.
Before the next one comes in, sorry, go on.
All right. Now, in terms of stamp duty land tax, okay? Stamp duty land tax, people think it's paid on the value of the property. It's not. It's paid on the consideration given, right? Those figures are usually the same, but if you purchase a property, that is usually the amount of consideration you give to buy the property. But in a situation whereby you have a transfer between two parties as a gift, and that other party takes on responsibility for the debt, the consideration they are giving is the amount of debt they take on. Now, if they're unmarried, the recipient already owning buy-to-lets will pay stamp duty plus the 3%. If they are married, the 3% doesn't exist. So it's just standard rates of stamp duty.
Okay.
So just to be clear on that, where you've got an equity release mortgage, Stephen. So if that equity release mortgage, and we know that rises because it's compounding of interest. Let's say it's 250 grand. Let's say you live in England. That means, and you are now married, congratulations, by the way. That means you would work out the stamp duty on 125 of that 250.
If she takes it over.
If she takes it over.
It's not just legally, it's if she makes the payments to cover that mortgage, she has beneficially taken over that responsibility.
Yeah.
And that is what the tax is charged on.
So hopefully that answers that question, Stephen, and let us know if it doesn't. But I just want to check back. Robert Stopper's just come back into this,
yeah.
And he says, for your information, there is also consideration as to setting it up as tenants in common for long-term care planning. So I know you've done some work with me on this before when it comes to how a trust document is set up.
Yeah.
It's a Schedule A notification on land reg. So on a residential property, we know we can do this separately for buy-to-let, but sticking to residential, a Schedule A notification is where that trust document is held for that tenants in common. So just going back to Robert's question, there is also consideration as to setting it up as tenants in common for long-term care planning. So have you got any views on that?
It's a legal question that there's not really a tax angle to that one.
Right. So that again, Rob, is a legal question. And as you were saying, that's something you've given.
We're also saying to do it for IHT planning.
Yes.
Right. There's not really a lot of IHT planning in the gifting. So if he's going to get married to this lady, right? Between them, depending on the size of their overall estate for IHT planning, you get 325 grand of allowance before you pay IHT. And if your estate is worth less than 2 million, you get another 175,000 related to your main residence.
Yeah.
Right? It's therefore useful to split it between the two parties in terms of house ownership. But say you didn't, if you passed first and you're married to the lady, if you don't use your allowances, she has full access to your allowances. So
how long is that for?
Life.
Life. Okay.
Yeah.
So again, Rob and Stephen, one of the things where you get a really good tax advisor, and I know John works in partnership with the solicitor, is where John would recommend for tax advice, a trust document, the beneficial interest, everything being set up according to, John would then refer that into a trusted solicitor.
Correct.
Who would then write that trust. So you literally, for instance, I have 4 buy-to-lets in my name. I want to pass that income to my wife. It needs tax advice, legal advice, trust document, register on land reg, backed up then, and that's what then would go into your account. So there's those questions. Dan, do you want to ask Samia's question?
Yeah, no, absolutely. I'll come on to Samia's question in a second, because again, it's a great question. But so putting my broker hat on,
yeah.
Obviously you've got a lender, the tax wizard and myself. We're seeing a huge shift in terms of seasoned investors now diversifying their portfolios.
Yeah.
Okay. The days where they're just getting a 3-bed semi and getting 600 quid a month is, I wouldn't say it's gone, but it is dying. We have noticed a significant increase in different areas. Now, what we have noticed that seasoned investors are doing from a yields point of view is purchasing commercial properties and semi-commercial properties. Is there anything pressing that advisors need to be aware of from a tax point of view that's different to full residential properties?
Yeah, so it's there's two key things on that. One, commercial properties, the stamp duty land tax is at a different rate, and it is on the whole value. So if you bought several commercial properties from the same vendor, you pay stamp duty land tax on the cumulative value, not on each separate property. And you may well be aware, but the first 150 is 0%, the next hundreds of 2%, and then everything thereafter is at 5%.
Yes.
With capital gains tax, the disposal of residential properties can be up to 28%. At the moment, the disposal of commercial property is at 20%.
Okay.
Right? And the other quirk that's come about from not that long ago, so it was a few months back, there was a case. If you incorporate a mixed portfolio that has a decent element of commercial property, so shop and flats, for example, and the commercial element is not just in to avoid the tax, the additional 3% stamp duty doesn't apply on the incorporation. It's specifically excluded due to a quirk in the legislation.
Right. Okay, perfect, brilliant. Well, that answers my question. Hopefully that gives everybody a bit of meat on the bone. So we know brokers are the glue that holds everything together in the transaction. And the first person that gets shouted at, you never told me this, which obviously you're not tax advisors, so you're not, but you don't have to, but it's just nice to have that insight. And another question which we get all the time, so we're seeing a lot of investors being quite savvy with their purchases.
Yep.
And we're also seeing a lot of portfolios getting sold off
that
are held in limited companies.
Mm-hmm.
But their investors are buying the limited company, but they hold the properties to avoid paying the stamp duty on them.
Yep.
Now, from a commercial lending point of view, absolutely fine.
Mm-hmm.
Yeah, we can arrange that because these commercial lenders understand what they're doing and how the limited companies are essentially transacting.
Yep.
But from a tax point of view, is there anything that can come back to bite you in the bum? Because it's not tax avoidance as such, but in a way it is as well.
No, it's not. It is genuinely legitimate way of doing a purchase. Right. If you buy a limited company, you're buying the shares in the company and whatever that company holds.
Yes.
Right. So you're paying 0.5% of the 0.5% stamp duty on purchase shares, unlike the stamp duty land tax, which can be up to rates of 12–15%, right? And it can be a sizable saving. What you need to be careful of is that if you bought the property, say £1 million, when you sold the property, you could deduct £1 million. If you buy the company, that gain is still latent in the company, and you or the company would have to pay that tax if you sold the property out of the company at a later date. Now, this doesn't bother some larger portfolio landlords because they intend to keep it and go forever. But for some people who are thinking, right, I'm actually looking to flip, move on, you might want to think about buying the property and weigh up the cost of the capital gains tax against the stamp duty land tax you have to pay.
Right.
Great question. John, I've got a question now that is something I'm so passionate about. So good morning, Samir Patel. This is Samir's question, but I just want to put a bit further context to it. So Samir is, the scenario is Samir's client owns 3 properties. One in joint names, which is the residential, and 2 buy-to-lets. Applicant 1 is a high rate taxpayer, but applicant 2 is on 12 grand a year. They have discussed moving the buy-to-lets in a limited company. Now, I assume that's because of the way that being taxed 50% of the rent will be taxed at that higher rate, and it's obviously not making funds. In this scenario, if applicant 1 removes his name from the buy-to-lets, what would happen to applicant 2 in relation to stamp duty, tax and capital gains? And just as a further bit, Samir, is the question is I'm going to ask John to cover off as well, is the only reason you want to remove applicant 1 is because they're a high rate taxpayer, whatever income they take is at 50%. But long term, that could have unintended negative consequences if applicant 2 dies, and or at a point applicant 1 retires and they suddenly go back to being a basic rate taxpayer without any income because maybe they didn't have a pension. So there's a lot of forethought needed. So John, can you just answer the question of could they move it to a limited company? 2, could they remove off applicant 1? Or 3, the concept of a trust document with the beneficial interest and a different apportion of tenants in common and that share allocation.
No,
Jesus, that's a lot.
it is. Applicants 1 and 2 married.
It doesn't say. Samir, can you just all owned in joint names? Yes, they're married. Thanks, Samir.
No worries. Right. So, yes, they could move it to a limited company. It's only 2 buy-to-let, so the various tax reliefs that are out there for businesses wouldn't be available. So on the buy-to-let, if they move it to a limited company, there would be capital gains tax payable by both parties and stamp duty land tax payable by the company at normal residential rate plus 3%. Okay. However, the equity in the properties would be owed back to the individuals, right? So if that's a substantial amount of equity, you've got a situation there where you've got a higher rate taxpayer paying up to 45%, 45%, and you've got the basic rate taxpayer. It may be worth their while to incur that cost of 28% on a gain if that gives them a very large loan they can draw out on tax-free. They've paid 28% rather than 45%. So it's worth doing the maths on those scenarios. If it's not worthwhile, right, as I already said, they're married, so they can transfer the properties between themselves without capital gains tax charge. There's a rule in the capital gains tax law that says spouses can transfer assets without charge. They can either do that by a conveyance, or, as Roger said, there is something called a deed of trust. And that is basically the beneficial ownership of the property moves to the spouse under this trust agreement. The higher rate taxpayer stays as the nominal legal owner, but for all intents, legal beneficial tax purposes, the lower rate taxpayer spouse becomes the owner. Okay, and that means that individual is then subject to the tax on the income. And you can't just transfer the rent, you've got to have the capital gain. They would be subject to the capital gains tax on any disposal. Right. There's no capital gains tax. Now, as we said before, if spouse number 2 becomes responsible for the mortgage, they're married. If that mortgage amount is more than 250,000, standard rates of residential land stamp duty land tax will apply. Yeah, the 3% doesn't apply on a spousal transfer of assets. Now you're right. You move on into the future and the circumstances change. Okay, but if they're married, we can still move between the parties. So less of a concern in the current scenario. Where it becomes concerning is if they weren't married. If they weren't married, you've got a disposal for capital gains tax between the parties, right? You've got the stamp duty plus potentially the 3% because they're not married. And in the future, you would transfer back with the same tax consequences. But as they're married, there are ways and means of being able to utilise the benefits. And it's a lot cheaper if one's got 2 buy-to-lets, keeps under the basic rate, which is 50 grand of income, right? Only paying 20% tax, no need for a company, quite a simple tax return. That is often the best solution in those scenarios.
So Samir, just to try and summarise, if this was something that you wanted to put to your client, it should be put through by a tax advisor because it is tax advice. What the tax advisor like John would do would be to give that tax advice that you create a trust document, in effect pass the income over to the basic rate taxpayer. John would then need to refer you to a solicitor to create the trust document. A trust document can be created by more than one property. So it's within that agreement, the two properties would be noted. And that would then, by that solicitor, be lodged on both properties' Schedule A notification on land reg. It is then down to the applicant there and then, the moment that trust document is lodged, to go on to HMRC's website and to fill out Form 17. It's a digital online form. And the tax difference, or in other words, the income being apportioned low rate taxpayer, does not occur until that electronic form is done, and it's a self-declaration. So you don't need your accountant to do it. But the key bit, if that's the direction you want to go to make the portfolio from, say, losing money to making money, is that Form 17 form. And you will need, when you sign it and send it in, send a copy of the trust document and explain it. It's got that Schedule A notification, and that's that seamless link. So a lot of the times they get the advice from someone like John, everyone pats themselves on the back saying, yeah, we're going to make a profit, but they never fill out Form 17. And every day you're losing income that you could be taxed at a lower rate.
Correct.
Perfect. No, that's a great question, and thank you very much so far. We've probably got about 5 or 6 minutes for more questions. So if you do have any more pressing ones, then please do ask them. But we've got asked another one, and we've had this one quite a few times. But again, it relates to clients diversifying their portfolios into the holiday let space, John.
Yep.
So purchasing the properties, and again, it comes down to the ownership structure. So limited company, the purchase the Airbnb holiday, whatever you want to call it, in a limited company. But the directors, shareholders, want to use the property for their own personal use. It could be a couple of times a year, ad hoc, for a week at a time when it's not rented out at high season, or go at Christmas time because it's magical in the Lake District or whatever. Their question of that is, what tax implications does that have, and can they use it?
They can use it, but there is a tax implication. So if and it comes back to, there is a distinction between you owning the property and the company owning the property. The company owns it, you own the company, right? So you are using the company asset for your benefit, okay? And that would be deemed to be, as a director, you are notionally an employee, that would be deemed to be a benefit in kind. So it would be like whatever the rental equivalent for the use of that property is, would be deemed to be a salary. It would have to go on what's called a P11D. The company would have to pay national insurance. You would have to pay income tax on the value of that. Your alternative solution is to pay rent to the company.
At market value?
At market value.
Okay, perfect. And hopefully that answers that question. And again, if you were to do that in individual names, so if you were purchasing the holiday home in individual names, bear in mind that a lot of lenders will not allow you to visit this property unless you're carrying out maintenance, because it would then potentially become a regulated transaction. So if they have a holiday home in their individual names, visit it themselves a few times a year, then essentially they would be at risk of not so much having the mortgage removed from them, because how would the lender know? But just essentially, it's not something that you're able to do in your individual name. So it's something that they need to think a lot about if they are purchasing a holiday home, if they're going to use it, and how they're going to structure that ownership. Would you agree?
Yeah, I would. It's so often people will buy in a limited company and then just think they can go and have a week stay in the holiday and not realise it's a benefit in kind. But also the government are heavily looking at holiday lets for a number of reasons. They are appearing to remove properties from the local community. So there's a negativity in Cornwall and Wales. And then secondly, unfortunately, during COVID-19, a lot of people who had them as a second home classed them as a business to get support from the government when it wasn't a true holiday let. So the government are investigating that where holiday lets are run as a business, properly managed, properly let out, and they are therefore contributing to the community, is a different thing than someone who's got a property that they lent out a little bit, but then use really for their own residential purposes, particularly about the rateable value. If a property is worth less than 12,500 rateable value, they pay no rates, no contribution to refuse being removed or anything. And that's there to support small business owners It's not there to support the rich who want a £2 million second home in Cornwall. Mind you, that wouldn't pass the 12,500 rateable value.
No.
But I think we get the point, Dan.
Absolutely, but we haven't, and I'm conscious of time and we're going to wrap this up shortly, but we haven't answered the main question. How can bridging help with PPR tax?
Right.
Ooh, wow.
So,
Wow.
We missed that.
Wow, Dan, that's a really good back of the
how
net.
does bridging help?
Mm.
Right.
What?
Well, it does. People often move between main residences. Okay, and this is the scenario I see bridging come into play.
Yeah.
Okay, so you are trying to go from one main residence to your next main residence, right? You can't move on your last main residence. And the tax angle there is basically if you acquire a second main residence, you still own your first, you are paying an additional 3% stamp duty land tax, right? And bridging may be required to help fund that also.
Yes.
Yeah. If you dispose of your first main residence within 3 years, you can recover your stamp duty land tax.
Mhm.
And that's even if you dispose of your first main residence to a company you own. In those circumstances, you might then want to look at what stamp duty land tax the company is paying, or you've also got the question of actually funding up that purchase as well. And actually, the company may do a bridging or before it gets refinanced into a full-time mortgage
Yes.
type arrangement. Yeah. So there are frequent bridges used in the movement of PPRs in the circumstances I come across, because the way that the land system works in this country and the purchase of your residence means that it's far from seamless, very, very clunky, and people are frequently left with 2 properties at the same time.
100%.
Dan,
100%.
Dan, we've got one last question in from Samia. This is a good one, John.
Okay.
I like this one. One more question from Samia, if we still have time to address. Another client of his who already have existing property portfolio in a limited company.
Yeah.
And also himself is a high rate taxpayer.
Yeah.
Currently, his limited company has rental income just under the VAT threshold.
Yeah.
He wishes to buy another property and wishes to open a new limited company and purchase to avoid VAT.
Yeah.
Would that work? I'm aware this is outside the scope of my advice.
No
So
worries.
would it work?
If they are residential properties in let out, there's no VAT. The rental of residential properties is exempt from VAT. So the VAT threshold only applies to what are called taxable supplies, right? So you can have 2-3 million of residential income, and if you've got a commercial property, that has to be opted to apply that. And that brought in 50 grand, you'd still not need to register for that. It's only the turnover on your taxable supplies.
So,
Go on.
go on.
If
Finish there.
in question, they are commercial properties, they have been opted to tax, and you open up another company in the same ownership to avoid the tax threshold, the revenue will just slam the 2 companies together for that purposes.
And that is a point also to me where when we have that stepping of corporation tax from 19 to 25,
Correct.
a lot of people think, as I did, well, I'll have 10 limited companies and keep it low. There's a ruling which puts it together. So I think the whole audience is asking Samir, are the clients' properties purely residential or commercial? The residential, we're okay. If they're not, then they've obviously got their issue. But that's answered. So Jan, I think we've done. What a great session.
It's been really good, hasn't it? It's been really good. I just want to finish off with one final point around bridging, which was essentially the focus today, but we haven't really covered it off. And that's not because we didn't have the content, it's because you guys asked a lot of questions and it's been really, really interactive. And I think everyone will agree that it's been probably the most interactive session that we've had.
I agree.
Not because we're sat like the 3 Musketeers sat in a row.
I think that helped though.
Yeah, it has worked.
I think that
It has
helped.
worked. Rog hasn't plugged Tandem or Coventry once today, can we just say? So well done, because
And you plugged bridging all the way through, which
Well, I
is really
haven't plugged
good.
Crystal, and I'm not going to plug Crystal. I'm just
But I
going to
think you
mention.
should. No, I think you should.
I could do, But no, I just want to mention around bridging finance. So again, it's not a tool that's in many brokers' toolboxes. Probably 10% of the broker market does bridging and regularly does bridging. everybody else either shies away from it or just might do it maybe once a year or once every 2 years. But it is a really, really, really good solution. As John mentioned, there circumstances come up more often than not where residential properties that clients are living in haven't sold, they've found the dream home, and essentially that dream home is going to go to somebody else if they don't act fast. The only way they can act fast is using bridging finance. Hold on to the current residential property, wait for that to sell, and then once that's sold, then they'll just have their new residential property. But with that, it tends to be where the current resi has all the money tied up in it. They might not be able to get a residential mortgage because of age or because of income, and they've had the capital growth over the couple of years, which has made them be able to afford a new home. So they tend to bridge against the two properties, the onward purchase and the current residential, until the old property sells, and then repay the bridging finance with the sale of the current property, meaning that the stamp duty is covered with the additional 3% until the sale's done. And also, people don't have the time these days. We've learned from COVID that time is more precious than money. Grandparents who live 200 miles away from the kids and the grandkids might want to move back nearby one day to spend time with the grandkids. And don't want to wait for the house to sell, do they?
No.
So at that point, they might want to get bridging finance in place because they found the dream home, not too close.
Neaton Stockton.
Yeah, not too close, where they want to act fast in it because they're going to lose it. So bridging's a really, really powerful tool, whether it's unmortgageable properties, chain breaks. There's lots of different reasons why you would use bridging. And the barriers that we used to come up against previously was bridging is expensive. And it was expensive compared to your 1-2% residential mortgages, but where are they these days? The bridging market hasn't really shifted in terms of rates because it's not massively affected by the swaps market because it's short-term lending. So ultimately, the difference between a standard term loan and a bridging finance rates is negligible, really. There's no bridging cowboys out there, certainly that we deal with. There's a lot of reputable companies, and it's just a market that I think you should get in. Again, similar to everything and what I see on all these webinars, if it's a sector that you're not confident in, whether it's bridging, commercial, development, second charge, whatever, speak to us. For the majority of your cases, you'll be able to refer across the Crystal, still earn the same amount of proc, but you've got no control over it, where you've got no compliance, and you don't have to be a jack of all trades. You stick to your lane, but any cases that you're getting in, which historically you will have declined, may have declined, or not wanting to get involved in, you can pass across to a partner like ourselves or any of the other packages in the marketplace, and they can help you turn them inquiries into income. Like I said, the majority of brokers that we speak to on a daily and weekly basis are screaming out for education. It's the number one thing, but also sales support because their income has dropped by up to 40%. As mentioned at the very beginning of this webinar, if you want to maintain the same level of income as last year, if not grow it this year, still be able to go on them flash holidays or even be able to survive in the current market, it's all about diversification and how you're diversifying in terms of the business that you're writing. You don't physically have to touch it. You can get it in. Yes, we can help that. We work in partnership with firm XYZ. What's your name? What's your number? What's your email address? They'll get in touch. It's as simple as that. Earning money's never been easier from my point of view. So just think about referral options and who you're going to partner up with. If you want to be Crystal, brilliant. If you want to partner up with another firm similar to ourselves, great. Just I must stress, have a circle around you like Rog, like me, like John, where they can add value to your business, grow your client base, and ultimately help you earn more income and increase your turnover. It's as simple as that. But that's my final thoughts. From me, it's thank you very much for joining today. Thank you, gents, for joining as always. I think you'll agree it's been a very informative session. It's been certainly thought-provoking for me, and I've grinned a lot, certainly a lot more than normal because I was sat next to you and I have to listen. But yeah, do you have any closing comments before we wrap this up?
Tuesday, the 5th of December is the next session we'll be doing with a big focus on affordability. And what we'll do is be able to bring up a set of example accounts just for John to be able to help you understand how to extrapolate the much needed income for residential purchases and remortgages. That's one, I think, area we should focus on, in my opinion.
Yeah, agreed. There's a lot of misunderstanding around what value people have in accounts, particularly entrepreneurs. Got difficulty getting mortgage, but actually they're really got individuals.
So it's a goodbye from me.
And me. Thank you very much.
And it's a goodbye from me. Thank you very much for joining as always. Dave from marketing, thank you very much for setting this all up. We couldn't do it without you. I hope everyone has a great day, great week, and we will catch you on the 5th of December. That's it. Over and out from the Northwest. Bye-bye.